Hello, my name is Pierre Villere, and I am the Senior Managing Partner at Allen Villere Partners, an investment banking firm providing services exclusively to the construction materials industry throughout America, with clients in 45 states. I would like to extend my own warm welcome to all of you and hope the world of concrete is a successful experience for all of its participants. Unfortunately, I cannot be here in person, and this is only the second time in 15 years that I have not been able to attend this wonderful show. You see, we are headquartered in New Orleans, and months ago we found ourselves sandwiched in between the Super Bowl last weekend and Mardi Gras this coming weekend, and flights in and out of our region were just impossible to find. But at least I can be here by video and welcome the opportunity to share this stage with Ed Sullivan. I'd like to share some of my own bullish thoughts on our industry, in addition to the upbeat report Ed is sharing with you today, the first one in many years for our industry. At our firm, we hang on every one of Ed's words, as his forecasts are instrumental in forming our own independent views of the broader construction materials industry. Ed was early in his prediction of the collapse of the industry, a message many did not want to hear, and now his forecast predicts much better times ahead, a view we share with him. And it is fitting that we are delivering this news in early 2013, the year that marks the 100th anniversary of the ready-mix concrete industry and all of the growth in the construction materials industry that it has spawned. Today, construction materials drives an entire subset of the construction economy as a whole, as evidenced by the attendees here at the World of Concrete. They are the concrete and aggregate producers, contractors, specifiers, engineers, and the entire cross-section of professionals that are essential to the success of our industry. Now, let me share some very recent and key data points that I think are very telling about what lies ahead for our industry in 2013. First, look at the performance of the stock markets in the last half of 2012. The Dow Jones Industrial Average has added 1,800 points since June, and almost 1,400 points of that gain have come since the week after the election in November. It is now within striking distance of its all-time high of 14,164 in October 2007, a milestone we will no doubt achieve later this year. Other indexes have fared similarly well and affect sentiment across the board. Next, the number of U.S. workers filing new applications for jobless benefits fell to a 5-year low, indicating a strengthening labor market. Initial jobless claims, a measure of layoffs, fell by 5,000 to a seasonally adjusted 330,000 in the week ended January 19th, the latest numbers available at the time we shot this video. The level of jobless claims is at its lowest point since January 2008, near the start of the recession. The recent drop in claims is a sign of a steadily, though slowly, improving labor market, since a decline in layoffs often coincides with increased hiring. Employers last month added 155,000 jobs, roughly in line with the average pace of hiring over the past 2 years. The jobless rate held steady at 7.8%, a historically high level, but down from the 8% plus level we have seen through much of the recovery. Third, the Conference Board said its leading index rose 0.5% last month after no change in November. The November index was originally reported as falling 0.2%. Fourth, new construction starts in December climbed 23% to a seasonally adjusted annual rate of $530 billion, according to McGraw-Hill data released last week. The sharp increase for total construction followed 2 months of lackluster activity, as several very large projects in December helped to lift the pace of contracting. By major sector, substantial gains in December were reported for non-residential building and non-building construction, while housing maintained the steady upward trend that has been present for much of the past year. For all of 2012, total construction starts grew 6%, to 463.6 billion, a moderate yet stronger rate of increase than what took place during 2010 when it was up 2% and 2011 when it was only up 1%. Fifth, the December statistics produced a reading of 112 for the Dodge Index. Note that the baseline of 100 for this index was established back in 2000, and this 112 number is up from a revised 91 for November. For 2012 as a whole, the Dodge Index averaged 98, well short of its peak in the 2005-2006 timeframe at around 155, but increased from the lows in 2010 and 11 of around 85. And last, it is one of my Wall Street heroes, John Paulson, and his pronouncements at a speech in just the last few days that are the most telling. Paulson is the famous hedge fund manager who made billions betting against the U.S. mortgage market starting in 2007, and his famous short position was documented in the book The Greatest Trade Ever. More than 4 years after the financial crisis that made him billions, he is bullish on the U.S. economy and housing in particular, a significant reversal for the man whose mortgage market short is the stuff of legends. In 2010, his personal tax return reportedly declared $4.9 billion in income, based on his correct guess on the mortgage meltdown. At his speech, Paulson said the housing market had shown a strong recovery, with prices up and the number of homes for sale at a decade low. Those factors will likely put pressure on builders to create new product, he noted, creating some of the most, quote, positive change in housing since the Lehman crisis. Paulson went on to say that for an individual investor, his best piece of advice was to go buy a home. This is probably the best time in our lifetime to consider buying a house, he said. The combination of low mortgage rates and tax deductions on housing means that affordability has never been higher. He added that he was bullish on the stock market and on the U.S. energy sector, whose growth could buoy related industries like chemicals and petrochemicals. Now let's take a look back at some key metrics of the last 5 years, and in the interest of time, I will use ready-mix concrete as a benchmark of measurement to help illustrate how far the construction materials industry sank. Let's take a look at these key statistics. The selling price of concrete peaked at $96.05 in 2009 and fell back to $88.39 by 2011. Volumes contracted from a high of 458.3 million cubic yards in 2005 to a low of 257.7 million in 2009. The contraction of 201 million cubic yards, peak to trough, translated into an estimated 37,400 parked mixer trucks, or 48% of the estimated U.S. mixer fleet at its peak in 2005. The majority of these mixers have been sold or auctioned and have been redeployed in Canada, Latin America, and the Caribbean. The last profitable year for the ready-mixed industry was 2008. The industry operated at a loss for 2009 through 2011 and generated $17.57 per cubic yard in collective operating losses in this 3-year period. This translates into an industry-wide loss of $4.5 billion for the 3-year period. But that is behind us, and the recovery is solidly at our doorstep. Remember, major segments of our economy have recovered strongly, such as automobile manufacturing, hotel occupancies, the restaurant business, and retail across the board, from luxury goods to mass merchants. Construction is lagging behind all the rest of these segments, and we strongly believe that the recovery ahead for our industry will be very robust. Here are some of our thoughts. From the depths of concrete production at 257.7 million cubic yards in 2009, we predict the industry will produce well more than 300 million cubic yards in 2013, a 50+ million cubic yard improvement from the trough. Don't be surprised to see shortages in mixer trucks and drivers, now that the industry has pared back its plant and rolling stock, you can expect to see a return to the human resource challenges of the mid-2000s. Cement prices are on the increase, and significantly in some markets. This always bodes well for ready-mix concrete production, as historically margins have improved as these price increases have been passed along to the contractors. Household formations and population growth will accelerate in the recovery, driving further demand for housing and adding further pressure on already low inventories and the current low prices. This will drive collateral commercial construction, and coupled with healing state budgets, will further drive public and infrastructure work. If I were to look into our crystal ball in relying heavily on all of the various market predictions, here is what we could see happen with regards to volumes, and this is just a bet from me. 2013, 315 million cubic yards. 2014, 342 million cubic yards. 2015, 373 million cubic yards. 2016, 408 million cubic yards. And 2017, 445 million cubic yards, close to the all-time high. Thank you for giving me this opportunity to speak to you, and I hope this video presentation has left you in a better frame of mind about the future of our industry. We are as bullish as ever.